Right now, there is one question on everyone's minds. Is Britain's overheated housing market going to experience a downturn? Well, since the government delivered their mini-budget on September the 23rd, there has been economic chaos. The pound fell to its lowest point against the dollar since 1985, and it has fluctuated since. This has caused gilt yields, that's the interest rate paid on government bonds, to rise. And that has had a knock-on effect on the mortgage market, causing mortgage rates to spike. This has made the cost of owning a home or buying one go up. Since the end of the first coronavirus lockdown in 2020, house price inflation has soared. And house prices have continued to hit record highs month on month until very recently. This has caused some economists to say that we are a good candidate for a housing market crash. So why are house prices on the line? Well, since 2019, house prices have gone up by about 25%. But wages have only gone up by about half as much. This means that the cost of housing has become unhinged from economic reality. Until very recently, house price inflation had stayed in double digits for months on end. All right, so back to the big question on everyone's minds. Is there going to be a housing market crash?
The housing market has become increasingly dependent on very low mortgage rates, and the extent to which we're seeing mortgage rates go up now is going to cause a lot of hardship for existing homeowners and people looking to get onto the market. It's quite possible that these higher mortgage rates will lead to a fall in house prices. We've seen potential buyers' budgets getting cut quite significantly by the changes in how much they can afford given the higher mortgage rates. That will feed through into the market. The exact scale of the falls is very uncertain at the moment, but it risks everything from a stagnation where prices don't fall but activity levels collapse through to a serious downturn. The housing market now is very different to the one that we saw in the 1980s and 1990s. A lot of the very risky, extreme mortgage lending that we saw during those periods doesn't exist anymore. That's had a cost. Far fewer people have been able to buy their own home. But for those who are in the market, they have been stress tested to within an inch of their life by their lenders. The problem is nowadays they borrow far more relative to their incomes than in the 90s or the mid-2000s. And that makes them much more exposed to higher mortgage rates, even slightly small ones, small increases from the levels we see now.
Rising mortgage rates are no joke. So who are they going to affect?
Rising mortgage interest rates affects everyone who's got a mortgage at the moment, particularly those who are coming off their fixed rates or they're on a variable rate, so they're subject to the rate changes happening in the market. Now, for those on low incomes, and particularly those who are on low incomes with a high amount of their mortgage still outstanding, the amount that those households are paying, if interest rates go up to around 6%, could increase to be around half of their income per month or per year. Now that's really worrying, and what we've also seen is that over this sort of next year or so, if everyone did move to around 6% interest rates, we could see around an additional 1 million people in a household with a mortgage pulled into poverty as a result.
If somebody has borrowed a lot at the top of the market recently and they're coming off of a fixed rate deal and they're going to experience higher interest rates, that could cause trouble. There is also a risk for private renters. If the mortgages of landlords get more expensive, they might pass their cost of living concerns onto their tenants. I am already hearing from private renters who have been hit with 30 or 40% above inflation rent hikes. When you look at the full picture, all of this could cause trouble for the reasons that our experts, Rachel and Neil, have outlined. Some economists don't like the term housing market crash. They prefer to say downturn or fall. But what we're looking at now is a situation where the housing market will likely either stagnate or house prices will drop. but a 10 or 20% fall will take us back to pre-pandemic levels. Despite the government's U-turn on their plan to cut the 45p top rate tax, there is still uncertainty in the mortgage market. Why? It's because lenders now fear further uncertainty and volatility, which might impact the way they price mortgages. All of this will have a knock-on effect on how much it costs people to borrow to buy a home. If it gets more expensive to borrow to buy homes, demand might go down. And generally speaking, when demand for housing goes down, so do house prices. Okay, are you still with me? Does anyone stand to win from any of this? If you don't currently own a home and you would like to, it might be tempting to think of a drop in house prices as a good thing. But remember, house prices did fall substantially after the 2008 global financial crisis. But at the same time, lenders tightened their affordability criteria, which made it harder for first-time buyers to get on the housing ladder. So who on average benefited more from that drop in house prices? It was investors. If interest rates go up, it will be more expensive to have a mortgage. So a drop in house prices may not necessarily benefit those people who don't currently own homes. There is a lot of uncertainty right now, and it's too soon to say how things are going to play out in the coming weeks and months. But what is certain is this: during periods of economic turmoil, Britain's lack of social housing, truly affordable homes, as well as our lack of protections for private renters who can have their rent put up or can be evicted at any time, is well and truly exposed. And now, people with mortgages may well find their housing costs soaring too.